Hello, everybody. Welcome to the Mosaic podcast. We've missed you guys. Happy New Year. Welcome to 2026 and congratulations for making it through 2025. You're tuning in with myself, Mandisa Zavala, Head of Asset Allocation, as well as the beautiful Mpom Lebiana, who is our Chief Economist at Alexforbes. Hi, Mpom.
Hi, Mandisa.
Welcome to 2026.
2026. Thank you. Hope you had a restful December. I know we flew. It feels like we flew out of here.
Yes.
The minute it hit December, and
I
the
know.
guys had to cover the podcast for us.
Yeah.
But happy to be back. And I was saying earlier that, 2026 is giving 10+4 vibes, like in the hour. Like, we've literally started the year with a bang, having left
Literally.
pretty much
Yeah.
tariff fatigued, right? Yeah. But, for today, I'd like us to, just unpack a bit 2025 and also, our thoughts on the year ahead. I mean, it feels like there's no easing into it, right? We are in the third week, but already so much has happened.
Absolutely.
Especially things that could certainly alter the course of the macro and returns. So let's just get into it. For 2025, from a macro point of view, I mean, it was quite a stellar year, if I must say, to growth. Growth did hold up pretty well. That's despite the trade policy uncertainty, the tariff shocks. And from an inflation perspective, also, we did see disinflation continuing, but there were some nuances in a sense that we did see disinflation being disrupted by tariffs in the US. In the UK, we also did see some upward pressure on inflation coming from administered prices. In the euro area, the ECB was sitting comfortably well with inflation already around the 2% handle. And that also led to a divergence in terms of monetary policy. So the divergence we saw in inflation also resulted in divergence in terms of monetary policy. We saw the Fed pretty much on hold in the first half of the year, easing by 100 basis points in the second half of the year. The ECB, on the other hand, because they reached the inflation target earlier, they were able to cut policy rates by 100 basis points in the first half of the year. And when we look at the BOE, they had to balance this, tepid growth and still high inflation environment. And what they did ease by 100 basis points as well, but, gradually so, essentially cutting by 25 basis points each quarter. And the Bank of Japan, on the other hand, remained on a tightening bias, starting the year by hiking policy rates by 25 basis points and ending the year with another hike, essentially. So those were some of the nuances that did come through from a macroeconomic policy point of view. But overall, still pretty much a supportive macroeconomic backdrop. Fiscal policy also came into focus. Remember, we had the One Big Beautiful Bill, which was enacted, and we had fiscal expansion commitments from Germany, but we also had the broader euro area also committing to more defense spending generally. So we did see fiscal policy come into focus as well in 2025. And in addition to that, in the UK, the government was also under pressure to balance the books. Eventually, they did manage to. And in Japan, we also had commitments of fiscal expansion. And overall, I mean, if you think about it, interest rates came down, disinflation discontinued, fiscal policy was pretty much expansionary. So pretty supportive backdrop if we think about it, essentially for returns. But, I'm not going to make the conclusion on that. I'll leave that to you, right? But, when we look at it, short-term rates, I guess they should have benefited from your, monetary policy easing, longer dated bonds, not so much so if you think about the fiscal pressures. I'd be, very interested to hear your, overall take. The politics that also came into the picture meant that gold was like literally on a one-way
Yeah.
streak
Yeah.
upwards, right? Oil range bound. So,
Mm.
Pretty much interested to hear, what did 2025 mean for returns?
I mean, getting into the 10+4 theme, I think, we started off 2025 also with a 10+4 theme. Come to think of it, really, it felt like the house was falling or Indiawa,
Yeah.
But I think even with all that volatility that we started off the year with, it's interesting that we had a much better year than we had expected at this particular time last year. I think everyone was scrambling to understand what, the tariffs meant, what Trump's agenda meant. And a lot of us capitulated on the back of that. I think we had great lessons to learn in 2025. And if you were willing to adjust to those lessons, I think you did exceptionally well. What we experienced was a year of really just overall strong performance, even with the US having done, on average around 17%. Most markets actually outperformed the US. So we came from a US exceptionalism theme to an environment where it was the opposite. I'm still looking for the word on what the opposite of US exceptionalism is, but it was exceptional in it, kind of lagging as opposed to it doing well. We had very strong performers from emerging markets in general. I think, we can't even speak enough about how great emerging markets were in a year of massive volatility. I think the overall EM index was up about 34%, over 34% in US dollars. It was very impressive. And interestingly, the best performer for the year was South Korea. Wow. And the number was above 100%. It returned 173%, 0.73%.
Wow.
I mean, if someone had just borrowed us $1 billion, we wouldn't be sitting here. We wouldn't be sitting here.
That's all
I'm saying at the current moment. All you had to
mojitos.
do, in the Bahamas at this current moment. But unfortunately, we didn't have the $1 billion to invest in the South Korean market, but it did exceptionally well on the back of this very strong AI theme that we spoke about. On the back of that, also, developed market equities outside of the US also performed really strongly. Germany was the one that we have to talk about. Returns were about 37% and above that you got from German assets. Even Canada was also on that terrain. So really, there was no market that you were not getting double-digit times 2, times 3% that you were picking up, except for the US. But again, it delivered around 17% in total, but developed market equities outperformed in general. I think the second theme as well that I'll talk about is also the experience of sector performance. There's also this, I do think it's a little bit of an assumption that perhaps performance came from one sector, which was IT. It wasn't really true, because when you look at the sector performance in general, you were getting very strong performance, yes, from information technology, but the best performing developed market sector was consumer services, which again is tied to IT. But I think the reason why I talk about consumer services is because one of the things that we had spoken about in the middle of last year was the fact that we felt that the AI theme was broadening out of just semiconductors and into other parts of the AI spectrum. So you saw also software coming through as a theme within AI. So we saw these sub-themes coming through, and those saw very strong returns. You got very strong returns from consumer services, as I've said, but also financials also did really well, 29% above in financials. We also saw the AI theme as well in emerging markets. And this was another theme that we spoke about, to say we do think people are going to start to look at emerging markets as a good substitute for the Mag 7. And we actually did see that. IT was up 54%, over 54% in emerging markets. And that also brings us to the best performing theme of EM, which was materials, on the back of very strong commodities that you spoke about, select commodities, but nonetheless that did really strong. So I do think that what we ended up seeing in that particular period is markets becoming also less susceptible to geopolitical noise. I think we didn't actually exit out of the tariff noise. Like you said, we were tariff fatigued. The market started to look beyond that. It started to look at valuations. I heard an interesting point recently around the fact that if you had taken a forward PE, markets with the lowest forward PEs last year, with the markets with the highest forward PEs meaning that those are the more expensive ones, and then the lowest forward PEs were the more cheaper ones. You actually ended up with the cheaper markets doing better than the more expensive markets. That tells me that the market went back to fundamentals. They started to pay attention to valuations, to say, okay, we can't take the signal anymore from the noise, the geopolitical side, even macro. And like you said, macro was all else equal quite supportive. It was just other things, other noise, noise around it that was actually hampering sentiment. And people went back to what are fundamentals, what are companies saying, what are the earnings? And I do think that's likely going to persist also going into 2026. One more theme that I want to talk about is also the dollar weakness as well. The reason why emerging markets did exceptionally well is also because the dollar was very weak. When you look at the dollar index as a whole, you actually realize that index went down by close to 10% just for the full year. So the dollar lost about 10% in value for the period of 2025. The benefactor of that was the emerging market currency index, which was up about 8%, but also the euro was actually the best performing currency against the dollar, which was up around 13%. And we saw that theme continuing to play out. Looking forward, we still do see the dollar weakness theme continuing. And I think as a result, it makes certain things quite simple for us to tick. If we're sitting with a checklist, if you're experiencing an environment where the dollar potentially continues to become weak and other things are supportive of a strong or environment that is potentially quite supportive of risk asset exposure, you actually still want to be in emerging markets. So for us, that's a very easy tick. And I say this with a lot of humility because I know markets can humble you and, something can change. So all else equal, the current environment is still very supportive for emerging markets. I do think there's a bit more nuance on the developed market side because we are starting today with much higher valuations in overall developed markets. So even some of the markets that started off looking much cheaper, like the UK, the Euro, the European market, are now seemingly on the expensive side or closer to fair value towards expensive. So it does become a bit more nuanced, I think, in those markets where you probably want to be a bit more selective. But I think we're likely going to see a lot of the themes that we saw towards the end of last year continuing to play out, especially in the first half of 2026. So we're not changing our holding, but I am interested because maybe you can say something that is different. What are you seeing from a forward-looking perspective on the macro side?
On the macro side, yeah. I mean, it's quite interesting, and I think we pretty much aligned. The key thing for us this year, I think one of the things that we had been started to discuss late last year was that politics will remain in focus, right? But how politics are coming in through this year is that we have US midterm elections in November. We have UK local elections around May. And then we also have SA domestic elections as well, right? Municipal elections. So politics will remain in focus. And, the way that we have interpreted the developments we've seen in the first 3 weeks of this year is through that lens, right? We know for US, what matters the most is affordability. When we talk about inflation, when we talk about prices, what it boils down to is affordability. And that's what voters are going to be voting on. And if you think about the intervention that we saw in Venezuela, the one thing that's coming through from the US administration is that they want more oil.
Yes.
Why do you want more oil? You want lower oil prices because you want lower inflation.
Yes.
Fuel is one of the easiest and quickest transmission that we tend to see into consumer prices, right? The minute you have lower oil prices, fuel prices decrease, you're paying less when you go to the petrol station, and that tends to be an easier transmission into affordability. So that's how we are viewing the policy development so far. We are not necessarily saying that what is intended with the policy is going to be achieved, but that's how we're seeing the politics come through. Is that yes, the impact tends to be through all prices, but it also feeds into the macro when you look at the impact on inflation and then what then eventually happens to monetary policy, right? So similarly, in that vein, this morning we woke up to the news that the Fed has been subpoenaed, and we then also had a speech by Powell, a video recording, saying that he will continue to do his job without fear and favor in terms of setting the policy rate, right? So we have briefly talked about the risk that the Fed becomes captured, it becomes politicized, and if you think about it, the policy impact there, or rather what would be intended is, a politically captured Fed, the intended purpose, or rather a politically captured central bank generally, the intended purpose tends to be lower interest rates, expanding quantitative easing to artificially create liquidity for the central bank to buy bonds, right? So we will continue to see that through the interest rate transmission mechanism, essentially. So, the way that we're seeing politics play out this year, particularly in the US, is that, yes, you have the impact on oil prices, which essentially the actions essentially means that there's a bearish view towards oil prices because the goal is to bring more oil rather than really to disrupt
which
oil
is
supply.
good for the market. It's
Yes,
actually
it's good
quite
for
good
the
for
market, especially
equities.
your importing countries, your oil
Yes,
importing countries generally.
Yeah.
But what that also means is that so you have this political risk, and there's an environment where gold did exceptionally well last year, right? And we think that the political noise will continue to favor gold as well. What it means for monetary policy as well is one thing that we had started discussing last year is that we are likely nearing the end of that easing cycle. So barring the pressure, political pressure on the Fed, our expectations were that there's still room for about 50 basis points worth of easing that we could see from the Fed. But, not so much from the ECB. Also likely another 50 basis points worth of easing from the BOE. So really not much, considering how much has been down already. I mean, we've had about 200 basis points worth of easing from these major economies. So we are now just talking about 50 basis points if we are even lucky, right? While the ECB is likely to be on hold. But again, if you think about it, interest rates generally on average should be lower this year than they were last year. So that still points to a still supportive macroeconomic environment, but maybe to a less extent than what we saw last year. Fiscal policy also likely continues to remain quite topical, in a sense that we have the One Big Beautiful Bill. Those tax cuts come into effect early this year. We should see those rebates going into consumers. So, that should be supportive of growth as well. Elsewhere, given the political climate, there is pressure for governments to increase their defense spending. How that will be funded remains unclear. Is it going to be through tax increases, which tends to be generally negative for growth? That could be the offset, or will it be through increased issuance, which essentially tells you that that fiscal uncertainty could continue to put pressure on your longer dated bond yields generally. But overall, we see a still supportive macroeconomic backdrop. If you think about it, interest rates continue to come down, although to a lesser extent. Fiscal policy remains expansionary. Politics continue to play out in commodity markets. Risks mean gold prices will be supported. Oil likely range bound to lower, and the narrowing interest rate differential that we continue to see we think also a dollar negative. So from that perspective, this is why I was saying that I think our views are aligned at this point of the year.
And it's good that it feels as if, at least for the first half of the year, there's a lot more going right than going wrong. Again, all else equal, according to this particular day, because anything could change. But with the information that we have at hand right now, it seems as though the stars are aligned.
Yes.
The second half is something that looks quite different, based on what we're also saying as well. But yeah, at least in the near term, we can find a little bit of refuge in the fact that the macro speaks to a supportive environment. And also from an earnings perspective, we definitely don't see any concerns on that route. Yeah.
All right. I'd like us to shift the discussion a bit to South Africa, which was, I think South Africa had a great year last year. And, at the beginning of the year, you wouldn't have said so, right? Like it looked very shaky, right? I mean, we were in the tariff crosshairs, like land expropriation, like all manner of accusations, right? And the sell-off and the pressure on the currency as well. But growth improved, and I think also to just say is that we've had quite a constructive view on South Africa when we looked at fundamentals, right? And, this is the one thing that we highlighted even last year amid all the noise is that, yes, sentiment feels very bleak, but if you actually look at fundamentals, they are beginning to improve. From a growth perspective, it's likely looking like growth is going to come out at around 1.3 in 2025. If you compare that to what growth was in 2024, which was around 0.5%, you're talking about almost a tripling of growth, right, of the growth rate, which I know at 1.5 it's nothing, 1.3, 1.5 it's nothing to write home about, but it is it's a significant improvement from 0.5, right? And that continues to be supported by easing supply side constraints, right? Electricity has stabilized. We also continue to see improvement in the transport sector. Concerted effort to actually crowd in private sector investment as well, in the energy sector as well as the transport sector, right? So for us, that continues to be supportive of this gradual improvement in growth we have been talking about. Inflation was also quite muted last year. We had the adoption of the 3% inflation target, which was, generally positive for when we think about inflation expectations, when we think about the fiscus as well. We did begin to see that turnaround in the fiscus as well. So generally, we remain constructive for South Africa in terms of the outlook. Inflation, we also expect that it will remain quite muted, because if you think about what we said on the commodity side, oil prices range bound to lower, gold higher. That's positive for South Africa's terms of trade. We talked about dollar weakness. So, the rand should also somewhat continue to benefit from that, right? So from an inflation dynamics point of view, that's supportive of still muted inflation dynamics, which means that we still expect about 50 basis points worth of additional easing from the SARB, and that still points to a supportive macroeconomic backdrop generally when you're talking about growth. From a fiscal perspective also, we're seeing continued improvement, and we could also see another rating upgrade. So pretty constructive South Africa. Where we see the biggest risk, it's the politics, right? So I did say earlier that South Africa also has municipal elections later in the year, and we normally tend to see a political risk premium being priced into the market given the noisy headlines. And the market generally just tends to have that knee-jerk reaction, right, to the noisy headlines. So that's where we see most of the risk essentially coming through from the politics. If we do see a sell-off in the currency, like I said, it could be negative for inflation, also could be negative for the fiscus as well. So that's overall where we see the biggest risk for SA for this year, but nonetheless generally constructive. I'd be very keen to hear how you're positioning for SA in this new year.
definitely hasn't changed. I think, to echo your sentiments, we still remain quite constructive on South Africa. We always have to overlay the constructive with cautiously constructive, because you never know what might happen.
Yeah.
But we're definitely more constructive now. In fact, we actually upgraded our view last quarter in order to be outright overweight SA. We had remained neutral to overweight for quite some time, and then we went in the second half, we went overweight, and that's benefited us. I think South Africa has done exceptionally well. It's, surprisingly, even when you turned on a Bloomberg, which is an international, news outlet, they'd be talking about South Africa. Very interesting. They wouldn't necessarily have the SA analysts there, but nonetheless, they'd have someone analyzing SA and talking about how strong the growth is. We saw over 42% of returns coming from the JSE index.
Wow.
That is a massively big number. And I know once you quote such numbers, people become afraid to say, do we repeat that? Where's
can that be sustained?
Yeah. That those type of questions, which are rightfully, they're right. We should be asking those things. On the back of the return last year was resources as well as basic materials. And I think we've overlaid a lot of our conversation thus far in saying we still do see some upside in the gold price. We still do think that there's upside also in some of the key commodities that were doing well last year. Your platinums, it's a supply and demand conversation. I mean, one day maybe we can unpack it even further, but those dynamics and fundamentals still remain in place. Yes, we saw resources up around 144%.
Wow.
Which again is like a very good number.
So had you taken that billion and put it in resources only?
I know.
Wow.
I know. We need to make good decisions. We need to make good decisions. And telecoms was also up 72% for the year. So those are really, really strong numbers. Yes, you had on the other side of the spectrum, healthcare and industrials actually declining. Industrials is seen as a bit of a more safe haven sector. You can see that it didn't necessarily come through quite strongly because people were actually buying the cyclicals in that environment. So I think performance was quite great. And we actually did see performance-wise, there was definitely a spread out of returns across the different sectors. But of course, like I said, there was a bit of nuances in there. Fixed income also did exceptionally well as well. We saw a downright parallel shift of the yield curve where, it started off in levels where there was 11% on the long end, 30% 30-year bonds. And then on the short end, it was 9.14. By the end of the year, we had actually experienced from 9.4, that 5-year yield had come down to around 7.3. And then on the other end of the spectrum, from 11, we came down to 9. So a lot of risk was priced out. I think from a lot of the stuff that you spoke about, inflation being anchored, but also the SARB and National Treasuries talking the same language. So there was a lot of fundamentals that were supportive of investors actually saying, okay, SA warrants a lower risk premium. And we saw that come through quite strongly. I think the one perhaps asset class which was maybe a bit of an underdog but was also came through slyly and people may not have recognized is SA property. It was actually in the background, but it did really well outside of the equity market. It was actually the best performing asset class. This year alone it produced over 30% of returns, and by the way, last year it had done really well at 28%. And this year it was at 30%. And by this time last year, we're talking about how, no, it probably won't repeat the same. And surprise, surprise, it actually did. I think the fundamentals were very supportive of it. We had lower inflation. We had interest rate cuts that were coming through. So even on the currency side, where you had the currency strengthening, all of those fed into the balance sheets of those property companies. The best performing sector in property was you had your retailers doing over 37%. You even had your industrial REITs, just normal industrials, actually also giving you 35%. So that return was across the different sectors as well. I think if we say, what do we see looking ahead? Because I've just quoted very big numbers, very big numbers,
very impressive.
Yes, very impressive.
We are all wondering, are we in for another year of,
or are we
stellar returns?
Exactly. Or should we be backtracking at this current moment? I think the fundamentals still remain strong towards South Africa, but I will overlay that and say over the next 6 months, they definitely do. I think, as you rightfully pointed out, that the risk is that we are currently in an election year. What we saw with SA asset classes is that there came a time where they were no longer responding to global noise. All the noise that was happening in the US, yes, here and there we'd see some losses in terms of certain times in a month where maybe there was a risk-off environment where you'd see SA assets selling, but typically they were actually they'd still do well even when you saw overall EMs coming down. I think what we've known when you look at history is that once you start to see local headlines, South African assets actually respond more to that. And when we're probably going to be seeing a lot more local headlines as we go closer to the mid part of the year, towards the end of the year, as we go into the elections, and that is a bit concerning. I think you definitely want to still maintain the view an overweight in South Africa, because there's still quite a lot of earnings that's embedded in those that hasn't actually been realized, but that is being estimated by analysts. So I think that should likely come through. But maybe in the second half of the year, we're probably going to start to see a bit more volatility coming in, and maybe some sell-offs here or there. But overall, we still think for the year, you're probably still going to be ending up with good SA numbers from an equity perspective as well as bonds. Barring, we also need to take into account that bonds have definitely done really well. Really well.
Yeah.
So that also, you sort of need to take it as well and be as active as you can in that holding. But we're not shying away from that call as yet. Paul, I think we need to get a bill. If anyone can lend us R1 billion,
R1 billion,
yeah, we can put it in there.
We'll pay it back.
Yeah, we'll pay it back.
Our returns
Yes.
realized. Yeah. Oh, wow. All right. That was very constructive discussion. Quite upbeat for this time of the year.
Yeah.
Despite the political headlines just a few days into the year. And thanks for joining us. We'll see you next time. Cheers.
Bye-bye.